And good evening, everyone. John Hutchinson with the Traders Reserve's Millionaire Blueprint. I want to welcome you to this evening's webinar presentation. And thank you for taking time out to join me tonight. I do have a great presentation for you. Running time is about 45 to 50 minutes. This is a live presentation. So this is Monday, March 23rd at 8:01 p.m. Eastern Time. This is not a recording. We will be recording tonight's session, and I will send you a link to that recording via email as soon as we complete our presentation here tonight. So again, running time about 45 to 50 minutes, and then I will stick around and answer as many questions as you folks have. I want to thank everyone again for joining me. Do a quick audio check so we can get underway right away tonight. So if you would, just type a yes or a Y in the chat box to the right of your screen. Let me know that you can hear me okay. Let me know that you can see my screen, which is currently showing the title slide, and we will be able to get underway. Folks are already starting to log in, and we have some folks from Motown in Canada. So feel free to let me know where you folks are from as well. Always like to know how far around the globe our webinars are reaching. So while you're doing that, I will also let you know that this is a program that taps into Google Hangouts. If you do not hear audio, if you have, which obviously is kind of ironic that I just said that, right? If you do not have audio, how would you hear that, right? So anyway, if your audio goes out, if you have an audio or visual problem, the simplest thing to do is to close your browser, go back to your email, and click back into the webinar from the link you were originally sent in your email inbox. Fastest, simplest way to get right back in without really losing a whole lot along the way. So again, we've got we've got Ed and some folks from Connecticut, Baltimore, Arizona. Rod Baker is on board. Excellent. Great. Jerry, sound is good. Thank you, sir. Tomikas, hello. Welcome. And Joanne, nice to have you along with us. Elliot, and then no name, bunch of no-name folks. Jerry from Edmonton. Welcome, Jerry. Greetings from Motown. Greetings, Motown. I'm a Detroiter myself, so Melbourne, Florida can hear us well. Excellent. And Forest Park, Illinois. So phenomenal. Great to have everybody here. We have Frank from Cleveland, Cadillac, Michigan. All right. That's up near my family has, or my wife's family, excuse me, has a little tiny cottage up in Arcadia. So about an hour from Cadillac, I think we are. Love it up there, especially in the late summer and early fall. It's just beautiful, beautiful golfing up there, beautiful lakes, and excellent people. So Dallas, Texas, Concepcion, welcome, welcome. All right, I'm going to say call ball game on sound is good, and off we shall go here. Let me just get a couple things set up so I can move my way right along, and here we go. So again, this is, I'm just going to start right at the top with the simplest premise. This is one that you most likely saw in our email. Before I get started, always have to make the lawyers happy, and also make sure that you are perfectly aware, as I'm sure you are, that this is a U.S. government required disclaimer, and that Forex future stock and options trading is not appropriate for everyone. There is a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. No representation or implication is being made that using the Millionaire Blueprint methodology system or the information in this presentation will generate profits or ensure freedom from losses. So basically, I just told you that you can't make money, and you but you can lose money, right? Isn't that real helpful? If you're a fan of watching paint dry, grass grow, or water boil, you're welcome to read our entire disclaimer at tradersreserve.com or millionaire-blueprint.com. Now let's get into the good stuff. This was our original premise: turning 250 investors into millionaires. And by the end of this presentation, your goal should be to be one of them. When we're finished, you will have in its entirety the only step-by-step investing plan specifically designed to create millionaires. It includes a unique investing plan that accelerates the growth of your money so that you can reach our $1 million goal in less time than it takes most people to pay off a car loan. It includes specific yet easy to follow rules so that you automatically secure investing gains and prevent portfolio wrecking losses. It includes the one number you need to know so that you're always buying the right stocks and avoiding the wrong stocks. When you put these three components together, you will have a powerful yet safe strategy that grows your portfolio by compounding your returns every single month. Not annually, but monthly. Now, I want to be clear that this strategy is not about high-risk investing, penny stocks, day trading, a get-rich-quick scheme, forex trading, or real estate speculation. We are and will be focused on investing in stocks and in the stock market, perhaps not in a way that you might think. Now, many people are concerned, certainly rightly so, that stocks have gone up so far, so fast since the 2008-2009 financial crisis that you may be worried we're in another bubble, or you don't believe stocks can keep going higher, or you may be worried that you're about to buy the top only to sell the bottom. And I have many of the same concerns. I'll be perfectly honest with you. I'm not a big fan of buying the top of any market. But what you're about to learn is so powerful because if you can follow some simple rules, you'll discover that it doesn't matter whether the market is rising or falling. You'll have a strategy to profit in any market condition. You'll never need to worry about buying the top of a market because our one-number strategy makes certain that you're buying the right stocks, not the whole market. And that provides you with profit opportunity and portfolio protection. You'll also discover that using our unique investing plan, your portfolio is protected. It's shielded against bear markets and huge losses. You'll see why and how this is done in this presentation. But you may be curious at least about why do we choose $1 million as a goal? Why not, $100,000 or $2 million or $10 million, right? Well, because if you're 40 years or older, you're likely facing what Forbes magazine calls the greatest retirement crisis in American history. It's one that will leave millions of people who are unprepared for retirement poor in their later years. Here's an example, or here are some illustrations why. First, Fidelity Investor survey from just a couple of years ago discovered that baby boomers face a $24,000 annual income gap in retirement. That means imagine living the life you lead right now today on $24,000 fewer dollars per year. For the average person, that would put them below the poverty line. Gen X faces a $20,000 annual income gap. 43% of retirees are in worse financial shape, and 34% can't even meet current expenses. And most importantly, 65% of Americans have portfolio values of $50,000 or less saved for retirement. Now, the same, the same company, Employee Benefit Research Institute, that originally put out that statistic on the 65% of Americans with $50,000 or less, just posted a new one today where the average value of a 401k was about $18,000 for most employees. So you can see that the numbers don't add up to a highly successful retirement for most people. Well, when you add to that, or when you think about this in the context of a retirement crisis, here's why that's a problem. The average portfolio, as I just showed you, is about $50,000. Just to have a secure retirement, think about how much money you would need. If the average income in the U.S. is $52,000, the average person retires now at 67 and lives about another 15 years, then just to maintain an average standard of living in retirement, you would need $780,000 in pre-tax dollars. Again, that's $780,000 just for retirement, and it's pre-tax. So it doesn't account for things like buying a home if you're a younger investor or just getting started. College expenses, again, younger investors or parents with children still in grade and middle and high school. College expenses now, $100,000 for 4 years of college, almost guaranteed. Vacation travel, if you want to do something in your retirement years, you're going to have to pay for it. And most importantly, and most frightening, the rising cost of future medical expenses with or without Obamacare. Right now, those are estimated at $250,000 for retirees, for an individual retiree. So when we set that $1 million goal, it's pretty obvious to see why, we didn't just pick that number out of the air. But when you sort of add all of those categories up, it means that $1 million is basically just enough. And that's if you zeroed out your account, you left nothing to your kids, sorry kids, but you zeroed out your account over the course of 15 to 18 years, just living on an average standard of living. Now, your standard of living will decline slightly as you get older. I think it does for everybody. You eat a little less, you use less electricity, things of that nature. But that, just setting a simple goal like that. But when we look at where most people are today, the average portfolio is $50,000. We can see there's what we call a retirement gap, which is about $700,000. Now, given that gap is really based on some pretty simple math, when you add it all up, it's a big number. It's over $700,000 per person. I mean, that's your retirement gap. Now, the problem with that is obviously if your average portfolio is $50,000, we're a long way from $1 million. So you have to question. The question is, how do you get there? How are we going to get there? And you have to understand a couple of problems that you're faced with. First, you don't have the same low-risk choices to balance your portfolio that you did have 6 years ago. For example, and I might talk a little bit about this more in a second, but CDs, bonds, mutual funds, and money funds, money market funds, all of those have collapsed worse than the stock market ever did. But it means that you have to be willing to accept some risk. And we'll show you how to limit your risk so that you're never in danger of losing it all when you learn the approach we're teaching here tonight. And realistically, time is working against most investors. You used to have that typical 50-year model to invest in, but most of us don't have 50 years now. Most of us may have 5 years, 10 years, 20 years. So the speed of the growth of your money is critical. You must grow your money faster than you are right now to get to that retirement goal. And again, that's just retirement. So in order to get there, you must be willing to invest again in individual stocks. We'll show you how to do it safely. But if you think stocks are dangerous, and I referenced this a minute ago, they're far less dangerous than bonds, CDs, and savings accounts. Money funds have collapsed in interest rates 86% in the last 5 years. Yields on bonds have fallen by over 50%. I mean, they're the new mattresses, basically. If you don't want to grow your money, that's where you stick it. So even though the stock market is breaking into new high territory, practically every other month, you have to understand why and how that's happening. First, the stock market is not a buy and hold market any longer. It doesn't mean that buy and hold is dead, but high frequency trading, computer algorithms, computer-based trading, they've created this trading world on Wall Street, a higher speed, higher rate of movement of money. And that compares to the investing landscape that we used to have 20, 25 years ago, right? You used to buy a stock, hold a great company for a long, long time, and then cash out someday far, far in the future. That doesn't exist any longer. As an investor, it means that you have to make some simple changes or you risk being left behind. So I want to prevent that from happening. And I know that's a rather lengthy introduction to get us sort of through some of the problems that are facing investors and what some of the solutions are. But by way of introduction, my name is John Hutchinson. I'm the creator of the Millionaire Blueprint and the investing strategy that you're about to learn. I'm also a published author. My book, The Wealth Shield, How to Invest and Protect Your Money, can be found on Amazon.com. I'm also one of the publishers here at Traders Reserve and MainStreetInvestor.com. But I'm best known as a wealth building expert, a strategist who helps people restore their retirement dreams while protecting their wealth, still protecting their money from risky or get-rich-quick schemes. So let's dive in. As I said, we're talking about stocks. We're talking about the need to embrace some simple changes. And one of the first things that I continue to see is that despite the rebound in the stock market, most investors today are still making some pretty big mistakes with their money and in the way that they invest. And it's probably the key reason that most people are having a hard time getting their portfolios to grow consistently. And there's a reason for that. First, it's because most investors are following the same investing models of the last 15 years. And we already discussed buy and hold, but also the diversification between stocks, bonds, and mutual funds. But here's the reality. In the last 15 years, the average return for most investors is less than 3% per year. Future returns are expected to be around 7% per year. Now, you might think that 7% per year sounds pretty good until you realize this fact. At 7% per year, you could put $10,000 every single year into the stock market, and it would still take you 30 years to reach $1 million goal. That's if you put 10 grand into the market every single year, and if you get that 7% per year. Now, really, not only are there too many ifs in that scenario, but the truth is most investors simply do not have 30 years. But if you can follow some simple rules, which I'm going to teach you tonight, in 8 years or less, this could be your portfolio. Now, I realize that's about $1 million in about 8 years, and I realize you're going to be a little skeptical, and I would expect that. But the purpose of this presentation is to show you how it can be done. And first, it's done by making a simple change in the way you think about your portfolio, and that change is to think in terms of time. In order to reach your financial goals, your portfolio should be structured based on how long you want to hold an investment with a specific profit objective in mind. Today, I'm going to teach you how to use short-term investing in stocks to accelerate returns by compounding your gains monthly, not annually, monthly. That will help you grow your portfolio faster than you're probably growing it now. Now, if you're active trader, active day trader, you know where we're heading with most of this. What you'll discover is you can use just part of your total portfolio, depending on the total capital you have available, up to about 10% or $10,000, and still get explosive growth of your money, but still keep your overall portfolio safe. You can hold fewer stocks in your portfolio, so it doesn't take you hours of time to manage your money. But because you are holding an investment with a specific profit objective in mind, you'll be able to compound your gains on a much faster rate to generate a higher rate of return. And that brings me sort of to an important lesson, one that you may want to write down. The key to successfully growing your portfolio is determined by increasing the annualized rate of return on your money. Let me demonstrate that for you. This chart shows the growth of your money if you had simply invested in an S&P 500 index fund over the last 15 years, something that millions of investors have done. In that time, you no doubt have heard markets back at new highs, right? So you probably think this means you should be raking it in. If you had bought and held this mutual fund over the last 15 years, you probably think should be doing great. Nothing could be further from the truth. It's unfortunately the lie, if you will, what they don't tell you about buy and hold. It tends to decrease your annualized rate of return. Yes, the market was up substantially in 2010, 2013, 2014. But over the last 15 years, if you put $10,000 into an index fund every single year, your actual rate of return was less than 3% per year. And at that rate, it would take you nearly 60 years to reach $1 million portfolio. So along with savings accounts, CDs, bonds, and now index funds, obviously nothing is working to get you to that $1 million mark. But let me introduce you to a new little friend called hypercompounding. If you can do this safely, you can do it in an IRA, in a Roth, a regular investing account. If you can buy and sell a stock, you can use this hypercompounding strategy. Now, if you don't know what hypercompounding strategy is, let me teach it to you very quickly in 2 slides because you'll get this instantly. It's a strategy that increases the annual rate of return on your money by compounding your gains monthly. And to do that, let's assume for a minute you were starting with $10,000. You get an average return per month, not per year, per month of 4%. After 12 months, you'd have $16,000. That's an annual return of 60%. Now that 4% per month is the compounding strategy. Here's the hyper. If you follow the same plan for a second year, starting with your $16,000 and still generating that 4% return per month, your money would grow to over $26,650 at the end of the second year. And your annualized rate of return over those 2 years is now over 83%. But also notice that in just 2 years, you've more than doubled your money, but you never needed to add a single penny. That's the power of hyper compounding live and in action. But let's get into some of the simple details behind the Millionaire Blueprint plan. This is step one. Step two will be the rules. Step three will be the right stocks. Those are the three components that I'm going to be walking through with you in the rest of this presentation. So we'll take just a few minutes to cover the plan because it's really one of the easy parts. The rules will be next, and then we'll get down into the right stocks. So step one in this plan is to determine how much money you want to start with. And again, remember that we're focusing on short-term investing, and I'll explain that in just a moment. But the most important point here is especially if you have a larger portfolio, is to remember that you do not need to take stupid risks with your money. You can take a small part, perhaps 10% of your total portfolio, and allocate it to your short-term investing account. If possible, and this will make sense shortly, you can start with about $10,000, although we've had people who have been successful starting with as little as $2,500. Well, the reason you're doing this is risk management. It's to ensure that no one stock you invest in can ever hurt your full portfolio. Now, if you have less money to begin with, I will be honest with you, you'll have to take on more risk. And the reason is because you need faster growth in order to get to that $10,000 starting point. But a little more on that later. The next step is to divide your short-term investing capital into 10 equally weighted groups or buckets. So if you're starting with $10,000, you'd have 10 capital buckets, each with $1,000 in it to start. Each bucket would hold one stock at a time, so the maximum number of stocks you would hold is 10. There's an additional risk management tool to reduce your overall, is an additional risk management tool to help you reduce your overall exposure. Now, again, this step helps you protect your portfolio from big losses, just like most people experienced back in 2008, 2009. Those are the two key steps to get started. You're beginning with short-term investing to get fast growth of your money and to begin the hyper-compounding process. And what you'll discover is that many of your short-term investments will actually only be held for between 30 and 90 days. That's the plan that we use. So we want to get that specific profit objective, and then we're out and moving on to another opportunity. Now, there's plenty more to the power profit portfolio concept here, which includes the ability to roll a stock up to other elements of your portfolios. You sort of saw in that pie chart, medium and long term, and we'll only be focusing on the short term in this training session to keep it simple. But here are some things. These are just some quick bullets that you can use to see some of the opportunities that you'll be able to move a stock up to a medium-term investment and try to get a larger profit potential, move it up to a long-term investment and potentially get 5 times the profit potential. So again, I'll remind you, this is not day trading. This short-term investments or stocks or other assets that are held from 1 to 3 months and have a specific profit objective. Once that objective is reached, you take your gains, repeat the process, and this is how you tap into monthly compounding. In our Millionaire Blueprint program, we target between 2 and 8% returns, which gives us a potential annual return, a targeted rate of return of up to 80%. That's what we're hoping to get. That's our target. And when you learn to do this, when you just put these little pieces together, you'll be able to make more money faster with just part of your portfolio using short-term investing with these goals in mind, and you'll never risk losing it all. But that brings me to the second costly mistake that many investors make, and that's that hope is not a strategy. To be successful with this or any investment plan, you must have 3 things: a simple, repeatable plan to come out ahead, easy to follow rules that don't take a lot of time, and a smart way to protect your money. But you might consider why most people actually do lose money, or how most people do lose money. And in a single word, it's emotion. To understand that, I'll share a little story here. A number of years ago, I was on a flight out to Las Vegas, sitting next to a guy from New York, and he was a very successful person, it turned out, and we were talking about gambling. So I asked him why he thought most people lose money in Las Vegas. And he said, people lose money because they don't have triggers to quit. Their emotional high or low gets in the way of making a rational decision. He said, I have two triggers, a profit trigger and a loss trigger. Whichever one I hit first, I pull that trigger and leave the tables for the night. Well, the more I thought about that idea, the more I realized it's the same principle when you invest, isn't it? I mean, really, you have to have triggers. But most people don't have a loss trigger. They have a hope trigger, right? They just hope the stock will come back. And they don't have a profit trigger. They just hope the stock keeps going higher. I mean, think about the last time you ever bought a stock, or that you bought a stock. Did you ever think to yourself, well, I hope this works out? Or have you ever had a stock that fell by 10 or 20 or 30% and you said, well, I hope it comes back? Or maybe you have a stock that was up 10 or 20, 30% and you said, I hope it keeps going higher. That's an example. Those are all examples of how emotion gets in our way and prevents us from being able to make logical, rational decisions. Now, we all know that. And we all know what happens next too. The stock gets up, it goes down, we give back all our gains, we're back to square one. It's how hope is a recipe for disaster. But as part of the Millionaire Blueprint rules, I'm going to give you the key to success here. And that key is to remove emotion from the equation. Now, I'll be totally honest. I get excited too, and just as mad when I have a stock that goes up or down. But by using what we call decision triggers, we can remove emotion from the equation. And by emotion, I mean fear, greed, and hope. By using profit triggers and loss triggers, you establish your profit target and your risk in advance so that you can automatically secure an investment gain or protect yourself from a big loss. That's because when you learn to use decision triggers, you are making your decisions before you ever commit your money to the stock market or any investment for that matter. So I'll say that again. With these two triggers, your decisions are made before you ever put money in the stock market, your profit trigger and your loss trigger. That's how much am I going to make and what's the maximum amount that I am willing to lose. Those are your profit and loss triggers. Now, I'll teach you out here our Millionaire Blueprint 2010 rules to investing. And in just a few minutes, I'll even share some trade examples so that you can see these decision triggers in action and how they can both secure that investing gain and protect you from a big loss. But let's quickly review the plan again. I'll just walk through this in a couple of simple steps here again. Remember, first two steps were to determine what our short-term investing capital base would be. We're going to assume $10,000 for our teaching purposes here. And then the next step was to divide that $10,000 into 10 capital buckets, each bucket being $1,000. And then the next step is to set our decision triggers. We need to make our decisions before we commit our money to the market. Now, those decisions, those triggers for our short-term investments are a 20% profit trigger and a 10% loss trigger. Now, let me make one quick note here. When I say triggers, I do not mean orders. Decision triggers are points at which you will make that decision to exit the stock, either on the profit side or on the loss side. They are not intended to be stop loss orders or sell limit orders necessarily. You can use those, but I'm not establishing them exactly as those right here, just so everyone's clear on that. Now, when we say we want to set a decision trigger on the profit side, that means that what we want is to lay out what's the maximum profit target we're after here, and that's up to 20%. Another key part of this is you may not get to that 20%. Maybe you get to 15 or 16%, and you decide, I'm going to take that gain. That's a good thing. That's okay. Just because it doesn't get to your decision trigger doesn't mean you shouldn't still execute and take gains frequently and frequently. Yes, that's right. Frequently and frequently. The more frequently you take gains, the faster your money will grow. So what you'll do here is to use these decision triggers to make those only important decisions. When you hit that 20% target, if you do hit it, you want to take your gains so that you start that hyper compounding process. The main benefit here too is to help protect you about giving back a huge gain. It can happen from time to time. It may happen from time to time, but the majority of the time, when that 20% trigger is hit, you're going to exit the trade, take your gain, and move on to the next opportunity. At the same time, you have to protect your money. And to do that, you'll use a 10% loss trigger. Again, a loss trigger does not have to be a stop loss order. And in many cases, it should not be. The reason, largely, especially if you're dealing with a small cap stock or a mid cap stock, is simply to prevent market makers from driving prices down and taking your stop loss out. That's really the number one reason. But with all of the alert tools out there, there's no reason that you have to use a stop loss. You can get out plenty of time if you need to. But at 10% below your entry price, this gives you a chance to analyze your stock and determine whether or not the fundamental reasons for owning the stock are still true. Has the company recently reported negative news? If so, maybe when this trigger is breached, that's the time to preserve capital and move on to another opportunity. Simply put, the 10% loss trigger ensures that you never let a small loss turn into a big loss, which is really what happened to most investors back in 2008 and 2009. When you put all of this together, what you'll discover, by that I mean the plan and the rules, what you'll discover is you don't have to be afraid to hit it singles and doubles. Winning in the markets is just like playing baseball. You'll score more often and win more games with realistic gains, consistently hitting those singles and doubles rather than swinging for the home run trade at every at-bat. So we've covered the plan, we've covered the rules. There is one final piece of the puzzle, and that's finding the right stocks to use with this new portfolio approach. Again, that approach is you're targeting gain-specific profit objectives within a specific time frame, either short-term, medium-term, long-term. And then now you've seen the rules that we use on the short-term side. So the last step is to find the right stocks to use. Typically, at this point, my good partner, my Millionaire Blueprint investing expert, Jamie DeLugash, would join me. Unfortunately, he wasn't available to join me tonight, so we're going to carry on as if he were here in spirit, if you will. So if you don't know Jamie, he's a 25-year veteran of the stock market and an investment professional. Halbert Financial Digest previously ranked his Rational Investor, a #1 newsletter. He currently writes for reputable websites, including Traders Reserve, Main Street Investor, MSN Money, and others. And he's the author of a forthcoming book, The Manipulators, Beating Wall Street's Earnings Game, which is due out next month on Amazon.com. The process that Jamie uses to find the right stocks centers on one number. You'll learn how simple this number is to calculate in a moment, but as the expert in the Millionaire Blueprint program, he does use a computer-based algorithm which ranks for him all of the publicly traded companies at the end of each month. This is so that he can get down to using his one number approach, which you'll see in just a moment. He then reviews his rankings at the end of each month by both sector and market cap. That's largely to avoid overexposure. And then he applies a qualitative analysis approach which re-ranks stocks into the top 10 stocks each month. Now, again, he's doing this at the end of the month, so that ranking is the top 10 stocks for the next month. You'll understand the importance of that in just a little bit. But these are the 10 stocks then that you would use, for example, in your short-term investing portfolio. And they're all based on one number that's used to identify the best stocks to own from one month to the next. Now, that one number is what we call the PE gap. The PE gap occurs when there is a difference between a company's PE ratio and the company's earnings growth rate. Now, don't worry about getting bleary-eyed here. This is fundamental analysis. Most of this is probably relatively simple for most of you. But if it isn't, don't worry. I'll show you how to get these numbers, because if you can add, subtract, divide, multiply, you can do all of this. This is very simple. But what you're looking for is this. When the price to earnings ratio is greater than the earnings growth rate, that means you have an overvalued stock. That's a stock that you typically want to avoid. When the PE ratio is less than the earnings growth rate, that means you have an undervalued stock, and that's one that you typically would want to buy. It's what one of our members calls buying growth at a discounted price. And he's absolutely right. So let me give you a quick chart example, just so you can see exactly what I'm talking about here. Here's an example of this stock is Manitowoc, and the company, this is a company that we recommended back in December of 2013. Now, what you'll see here as we go through this and a few other examples is sometimes the wider the gap between the price to earnings ratio and the earnings growth rate, the better the overall opportunity can be. In large part, what we see are PE gaps triggering gains of 15 to 30% in our short-term investing timeframes. Again, that's 0 to 90-day timeframes and 15 to 30% gains. And if you think back to our rules and our plan is short-term investing up to 90-day holding time, and our rules, our profit trigger was 20%, right? So that's right in the sweet spot of the types of gains we consistently see in these undervalued stocks by using the PE gaps one number approach. So let's take a look at this example, and then I'll teach you how simple this one number is to figure out and to calculate. So this is Manitowoc. Again, the stock symbol is MTW. They're a heavy crane manufacturer, a stock that our PE gap approach identified at the end of November 2013, a stock that we then recommended at the beginning of December 2013. Now, at the time, the stock had a PE ratio of 16 and an earnings growth rate of 19 that yielded a relatively small -3 PE gap. But again, remember that when the PE ratio, here it was 16, and the earnings growth rate of 19, the PE ratio is less than the earnings growth rate, means we have an undervalued stock, and that's a stock that we want to buy. Now here, we recommended Manitowoc at the beginning of December 2013. We had an entry price of $20.59, and you can see on the chart how quickly that stock was repriced by Wall Street. Within just over 30 days, it reached our 20% profit trigger, and for some of our followers, they actually held on longer and enjoyed double that return in about just about 90 days. So that's how powerful this very simple approach can be for you. Fast gains, which then you turn over into another stock for another gain, the month after month. Just simply repeat the process. But let's get back to the quick lesson on PE gaps here. This is the simple way to always know what to do. When the PE gap is negative, it means the PE ratio is less than the earnings growth rate, which means the company is undervalued. That's a stock that you want to buy. When the PE gap is positive, that means the PE ratio is greater than the earnings growth rate, which means the company is overvalued. That's a stock that you want to avoid. Now, a couple of quick notes. We do not short stocks in our Millionaire Blueprint program. More details on that a little bit. But for those who like to play both sides of the market, you can actually use the PE gap positive side for potential shorts. So last but not least, remember that the wider the gap, the better the opportunity for short-term gains. Now, so next up, let me show you how simple this is to calculate. I mean, seriously, you can do this right at home, all right along with me. First up, we use Yahoo Finance to get the number or the information that we need. Any financial portal will do as long as you can get the three numbers that you need, which are the current stock price, the current year's earnings estimate, and next year's earnings estimate. Now, on Yahoo, if you type in a ticker symbol and then scroll down the left-hand menu until you see Analyst Estimates, that's the tab that you want to use to get the earnings estimates. So here we're going to use American Airlines as our example. And once you're on that analyst estimate page, you can see the three numbers in red outlined for you here that you would need. First up is our current price at $51.40. Then our current year's earnings estimates, which are $55.72. And our next year's earnings estimates, which are $8.42. Now, please note that this snapshot was taken in December of last year to 2014, so just a few months ago. It's the process that matters here, and not that this is, a today chart or a today number versus 3 months ago. So now that we have the three numbers we need, we can move on to our 5th grade math lesson, right? All right, so here, let's first up calculate the price to earnings ratio To do this, you divide the current price by the current year's earnings estimate. So with our American Airlines example, that's $51.40 divided by $5.72, which gives us a PE ratio of 9. Now hold on to that number. Next up, we need the earnings growth rate. To get that number, you divide next year's earnings estimates by the current year's earnings estimates. So let's go back to American Airlines here, and that would be $8.42 divided by $5.72, which gives us a 1.47 return. Now, to get the percentage, you would subtract the 1 from that. So we have an earnings growth rate here of 47%. So now we have everything we need to calculate the PE gap. Here's how easy that is. You subtract the earnings growth rate from the PE ratio to get the PE gap. That's it. So for American Airlines, we had a PE ratio of 9, which is then minus the earnings growth rate of 47. We don't need the percent here, just a raw number. It gives us a negative PE gap of minus 38. So our gap is negative, which you recall means the company is undervalued and we would want to buy the stock at current prices. Now, if we bring everything together, the plan, the rules, the right stock, and see this in action, put all of this together for you. This is an actual recommendation that we made in the Millionaire Blueprint program at the end of September 2014. So just 5 months ago. We would have used one of those buckets, one of those 10 capital buckets, to buy the stock at the market open on the first trading day of October. That was October 1st. Now, you'll recall I told you just a few slides ago that Jamie runs this model, this qualitative analysis process that ranks stocks at the end of each month. We then apply the one number process to get the 10 best stocks for the beginning of the next trading month. So heading into October, American Airlines was one of our 10 top stocks. Delta Airlines actually was one of our top 10 stocks in the same month. And it's intriguing because airlines had a very, very good month in October. So here we would have used one of our capital buckets to buy this stock. The opening price again here was $34.50. So, but remember that the first step we have to make is to determine or make our decisions as it relates to our decision triggers on the profit and loss side before we commit our money to the market. So we set a 20% profit trigger and a 10% loss trigger. So once we have entered the stock, we simply multiply our entry price by 1.2 to get the profit trigger. Here, that's $34.50 times 1.2, which equals $41.40. So we have set a ceiling. We set our profit trigger. Next, we set our loss trigger. We multiply our entry price by 0.9, again, because we have a 10% loss decision trigger. So that's $34.50 times 0.9, which equals 31.05. That's our loss trigger. Finally, we step back, we let the market do the work for us, and we let the trade run to conclusion. But before I sort of get to that, I do want to share a little secret with you. This is something that we do in our Millionaire Blueprint program, something that you probably want to learn to do as well. And if you remember, when we talked about loss triggers, I told you that it's a decision trigger. It's a point at which you have to assess whether something fundamental has changed with your stock when that loss trigger is breached. In our program for members of our Millionaire Blueprint family, that's what we do. When a stock reaches that 10% floor, we'll advise our members whether we believe they should close the trade or hold the trade, and the fundamental reason for doing so. Here with American Airlines, you can see that there's a big red dip right at the beginning of October of last year. Does anyone remember the CNN and MSNBC hysteria at the beginning of October? Does Ebola ring a bell? Recall the healthcare worker from Texas who took a commercial flight to Cleveland while exposed to the Ebola virus. You're looking at 6 days of headline selling. Those are computer-based or automatic programs selling news, selling headlines, if you will. In other words, it's mass hysteria, which translated into really all stocks in the airline sector being sold off by 15 to 25% in 1 week. But here's what we did. We actually sat tight. Why? Because nothing fundamentally had changed about American Airlines. Earnings expectations did not change. Oil prices were just beginning their acceleration down, which meant more profits for the airlines, and passenger traffic did not change one bit despite the 24/7 news cycle, the Ebola news cycle. So we sat tight, and ultimately, as you can see on this chart, we were right to do so. Within 20 days following that headline hysteria, we were at our 20% profit target in 20 days. That wasn't enough for us, though. We actually, if you recall the pie chart earlier, and I told you that you can do some additional steps to be able to take advantage of larger potential gains, we actually moved this to our medium-term portfolio with a 40% profit target. And still following some simple rules, just like our short-term targets here. And within another 30 days, we had that 40% target reached. So now we've actually moved American Airlines into our long-term portfolio. We've replaced it with other stocks down in our short and medium-term portfolios, but still trading up in the mid-50s. And we have a profit target on that stock of $69. So if we get to that point, that's our decision trigger. We can take our gain. That would actually be a true target or a true return of up to 100%. So far, it's been about 6 months, and we're going to hold this for up to another 6 months and see if we can get to that $69 price target. So let's do a couple more quick examples. I'm also going to show you the losing side here and how the plan and the rules protect you from portfolio wrecking losses. Now, this is US Silica. SLCA is the stock symbol. It was a November 2014 recommendation, which at the time had a negative 35 PE gap. Now, I told you earlier, big gaps equal big opportunities, right? But we were cautious with this one because it is tied to the oil industry. And obviously at that time, oil prices were still under siege. So nevertheless, we had an opportunity. We decided to take it, which means we have to make our decisions first. We calculate our profit trigger and our loss trigger. The opening price at the beginning of November was $45.57. So our 20% trigger is $54.68. And our 10% loss trigger is $41.01. So we've set our ceiling. We set our floor. We're following our rules. We have a fundamental basis for making this trade. We'll see what happens next. And that one did not work out. Now, here's what happened and what we did. Oil continued to fall dramatically right at the beginning of November. So that's a fundamental negative. The story had changed. Within 2 days of executing this trade, our 10% loss trigger was breached. We told our Millionaire Blueprint members to exit the next day and close the trade. Preserve capital. Why? Again, because the fundamental reason for making the trade, which we saw as a stabilization in oil prices, was not happening. Ultimately, we closed the trade the next day at about an 8.5% loss. But let me put that into a dollar context for you. And remember, if you started with $10,000 and divided that into 10 capital groups, that means you would have used about $1,000 on this trade and on the American Airlines trade before it. So with a 10% loss trigger in place, that means that your maximum loss or your maximum risk here is just $100. That's it, $100. So in that $100 is 1% of your short-term investing portfolio. So you should be able to see here how even a losing trade doesn't wreck your portfolio. And in this case, we made absolutely the right call. Oil continued to completely fall apart. And you can see that if you had tried to hold on to this trade any longer than actually did, when we preserved a pretty decent amount of capital, stock price actually collapsed all the way down to $23 a share. The irony, the funny part of the story is we actually came back to US Silica a couple of months later in January. And we were able to pull out a small gain on that same company as the price of oil began to rebound. So sometimes you have to preserve capital, and a losing trade is going to happen. But you know what? If you're preserving 90% of that capital for your next trade, then you have a much better and faster way to make it up. So, however, lest you let one losing trade get you down, in the very same month of November, we also recommended automotive supplier Meritor, which had a negative 20 PE gap at the time of our recommendation. So we go back to the rules and once again set our decision triggers based on the market open price on November 3rd. That was $11.55. Profit trigger was $13.86. Loss trigger $10.40. Once our decisions are made, we let the market do the work for us, and boom, it happens just that fast. 9 days later, we had a 20% winner. Now, ultimately, we moved that one also to our medium-term portfolio, where it worked up to about a 32% gain. It's come back down a little bit, so we're still holding it. We're still waiting. We're still expected to get right back up to that 40% level, but we're in a profitable state, and that's all we are worried about. So we had 3 trades there. You've seen a couple of quick gainers here. You've seen a loser. So you sort of get a sampling of the different types of trades that can happen to you. Now, in the same month, that month of November, I showed you U.S. Silica and Meritor sort of side by side. And this is the approach that I prefer, which is making my decisions, taking my money, move on. But if you were following that, you would have had one trade, the U.S. Silica trade, that lost 8.5% up to 10%, so between $85 and $100, and one trade that gained 20%, so that was $200. That's just 2 of the 10 buckets that I was showing you earlier that you would have. Remember, you would start with $10,000, divide that into 10 equal buckets of $1,000 each. This is just 20% of the portfolio. There was a whole other 80% you could have been working with here. So across just those 2 trades, you would have been ahead by 1.15% on your money. And if you were 5 more trades or 5 more combinations of trades, I think it's pretty easy to see how you can get to that 3, 4, 5% per month that I've been talking about. So let's take a quick look at a full run of our plan in action, from the plan to the rules to the stocks. I'm going to use February 2015. And I'm going to show you the 10 stocks that we had in our short-term portfolio with a return across the 10 stocks for the month. That return was 9% for the month, and I'll show you how it happened and sort of put some of the pieces together for you here. The big winner that month was Cons. That's right at the top of that chart there, CONN. That was just that stock. They had a great earnings report, a better than expected earnings report, and they gapped up. And actually gapped right up over our 20% target. So we wound up with, I think it's a 27% gain on that one. I'll show that. We'll take a look at that on the next chart. Here's U.S. Silica. I told you we got back in on that one, and you'll see the results on that in just a minute. And a couple of other trades that we had running, Whirlpool, Sportsman's Warehouse, that's SPWH. Just in terms of full disclosure, those 2 trades had previously been open heading into February, and then you'll see how those trades worked out just even within the month, excuse me. But you'll notice that none of these names are penny stocks. They're not OTCs. They're not pink sheet stocks here. I mean, you have USG, which is a home builder, Whirlpool, Bank of America, United Airlines. So here's what would have happened to you. You can see there a nice range of PE gaps. The plus 10 is actually a typo there. But you have a nice range of PE gaps. You have small to large to extremely large. So the range of opportunities within that short-term investing cycle. And again, so what I'm going to do here is actually show you how you would have put this into the plan. So you can get a sense of, if you were starting with $10,000, what you actually would have done. But these were the 10 stocks. So again, Cons, Bungie, USG, Sportsman's Warehouse, Aircastle, Whirlpool, U.S. Silica, United Airlines, Tudor Perini, and Bank of America. Again, all very good names. You can see these are the returns for the month. And then this is, if you were starting with $10,000, this is what you would have done. You would have had total invested capital across those 10 stocks, including a commission expense here of about $9,648. Now, to make this as real world as possible, I'm trying to account for both cash and some commissions here. So total commissions would have been about $70, depending upon how much your broker charges you. Might have been as much as $100. So you would have had some excess cash of a couple of $100, in part because, or only because, you would have been able to use exactly 100% of your cash based on stock prices, since you can't buy fractional shares. But by the end of the month, these 10 stocks, which included one of them being a 10% loser, had a total value of $10,800, which means for the month, You made 9% in that 1 month on your money, on your invested capital. Now, what did I tell you earlier that most investors are making per year? 3%. Here's 9% in 1 month, and it's that simple. Now, here's essentially our running, since we instituted this program back in October 2013. And you'll note the consistency in turning in positive months. Yes, we've had some months. We've had January 2014, January of this year, March of last year. We've had some months that have, where the overall markets have been down. But you can have a down month and still come out ahead over the next month. If the next month is a good one, and you could see both February's 2014, 2015 have both been very, very good. And actually, we're up about 2.5% for the month of March this year. So, it's just this constant application. Take what the market gives you. Don't be greedy. Don't be afraid. And don't hope. Set those triggers. Set those targets. When you hit one or the other, execute. Execute. That's it. So, over the last... well, what is that, 12, 16, 17 months, we're averaging just over 5.1%. That's since inception. So if you started with $10,000 and you stay on that monthly return path of about 5%, within 8 years, that's how you'll build your portfolio to $1 million. 5% per month in 8 years is $1 million, starting with that $10,000. And most importantly, you'll never need to add a single penny to your account. That's how powerful this program can be for you. It's also why we say it's the only step-by-step investing plan designed to create millionaires. It includes everything you need to achieve financial success. You'll have the plan, just as I've taught it to you here tonight. You'll have your decision triggers and the Millionaire Blueprint rules, just as you've seen in action here tonight. And you'll have the right stocks to use with your triggers in your plan based on the simple one-number formula, just as you've learned how to do it here tonight as well. So tonight, I'm giving you a choice. You can join our Millionaire Blueprint family and speed the growth of your portfolio, or to be perfectly fine, and this is absolutely fine if you want to do this too, you can go it alone. Just remember that going it alone could mean that it takes you 30 to 60 years to reach your financial goals. If you want to save yourself 40 years, then I want you to reserve a seat at the Millionaire Blueprint table tonight. And I'll tell you how to do that in just a moment. But you can choose to join us for our 60-day trial. That's 2 full months. Over the course of the 2 months, I'll tell you everything that you're going to get in just a moment, but over the course of the 2 months, you'll have 10 stocks per month. So that's up to 20 stock selections, $79 trial. You get complete access to the entire program. It's not half access. It's not partial access, etc. So I'll put it in the admin notice box. Give me just a second to type this in, and we'll get everybody's questions answered here in just a second. I'm also going to take a minute to tell you exactly what's in the Millionaire Blueprint trial as soon as I can get this typed in. Just a second. This is how you know it's live, because it's taking me forever to type it in because I type too slow. And OP and trial. So there's a link in the admin box coming up now, and then also I'm sticking it in the chat box. There's also a little thing called the pop-ins, which you should see next to the chat to the right of your screen there. It should say pop-ins. You can click that and you'll be able to reserve a seat there. But so again, it's $79 over the 60 days. You have 2 full months of complete access to the entire Millionaire Blueprint investing plan. It includes 10 short-term stock selections each month, so that's 20 in total over the next 2 months. That will help you know right away how fast this investing plan can help you and work for you. Now, here's exactly how the program works. Again, I told you that Jamie DeLugas makes the monthly trade recommendations at the end of each month. Remember, this is short-term investing. This is not day trading. Our goal is to turn over our portfolio as frequently as the market will allow, so that we're compounding our money from month to month. That's the hyper-compounding strategy. That's how we get that explosive growth in our portfolio. And our maximum holding time for a short-term trade is typically 90 days. Sometimes we'll break that. if we have a good stock, if we have a good reason for doing so. But typically, we're going to hold up to 90 days to get that 20% target. So once you have the stock selections at the beginning of each month, you'll enter your trades on the first trading day of the month. For April, that's going to be Wednesday, April 1st. Yes, I know it's April Fool's, but we're not kidding. Now, we do enter on the first trading day of the month because we're not market timers. We're not technical traders. We're not using some weird convoluted scheme. I told you earlier that process that Jamie goes through, the qualitative process, ranks stocks at the end of each month, and then the list that he generates is the top 10 stocks for the next month. So we want to get in and get our money working as quickly and simply as possible. So once you've entered your trades for the month, you follow the rules. Those are your decision triggers. And we'll be guiding you every week along the way, so you'll never be alone. Just like I showed you with American Airlines and US Silica, when there's a decision to be made, you will know what to do because we will help you make the right decision. We'll also tell you why that decision is the right one. So you'll get updates, you'll get alerts every week when there's an action to be taken. That includes email and text message alerts, so you can always take the necessary action. When our 20% triggers are reached, we'll close the trade, take our gains, and move on to another opportunity the following month. Now, unfortunately, there are a lot of you here, so no fighting over seats, but we have about 40 seats left for March. You need to act quickly, but this offer will be open until Sunday night, that's March 29th at 7 p.m. And the reason is we're coming out with our next, it's Tuesday the 31st. My fault. I'm thinking of last month. My fault. It's Tuesday the 31st at 7 p.m. Again, because our stock selection report comes out on the last day of the month, so you have to be in before that report comes out. Otherwise, you miss out on the trades and you can't get in. So that way you'll have the trade selections to make for the very first day. But again, the link is in the admin notice box. You can also use the pop-in box to the right of your screen to get the instant link to reserve your seat now. So again, do it immediately. Save yourself that 40 plus years. Because once you join, here's what you're going to get. You're going to get the Millionaire Blueprint monthly stock selection report. Again, that includes the complete short-term investing portfolio. That's up to 10 stock selections for the next month and for use with the 2010 rules to investing. You'll get the 2015 version of the $1 Million Portfolio Blueprint report. That's the Millionaire Blueprint plan. That's coming out here in the next 2 weeks, so this is a perfect time to get in. That details the short-term investing portfolio plan in a little more depth than I've taught you here tonight. It also includes more on the 2010 rules and the PE gap methodology, those as I've taught you here tonight. You also get trade alerts and regular updates. Every Tuesday and Thursday by 7 p.m. Eastern, you get our midweek updates. Every Saturday morning is our comprehensive Saturday review. That's where Jamie goes in depth and looks at all of our open trades. He looks at the returns. He does all the calculations for you, talks about the key events that are driving stock selections. Plus, you'll also get our action to take alerts. So text alerts. So those are by email, and by text. And so whenever we want to close a trade, you'll know exactly what action needs to be taken and when to take it. You also get 3 free bonus reports, advanced profit strategies, a $2,500 plan, and our capital management spreadsheets. The capital management spreadsheets are important. They do all of the work for you in managing the 10 buckets in the Millionaire Blueprint portfolio. There's even a training video to help you use these simple Excel spreadsheets your very first month. You'll also get on the fast track with our Millionaire Blueprint Bootcamp training video. This video walks you step by step through how to get ready for your very first Millionaire Blueprint trades. It also shows you how to let the capital management spreadsheets do the work for you and what you should expect as a member and what you should spend your time doing, because it's not trading. So get out and do the things you want to do, because we're going to be doing all the hard work for you. That's basically what it comes down to for you. So each month you also get up to 2 live strategy sessions with me and with Jamie. That's where we'll help keep you on track for success. We'll answer questions that you have, review the portfolio, We'll take a look at the trades that we've made, do special training on other topics with our members from time to time. All of that's included in your Millionaire Blueprint test drive. And you'll also get our Millionaire Hotline email. This is direct access to me and Jamie via a special email account, so you can get your questions answered fast. It's your instant lifeline for help. Plus, you also get the members-only website. This is where you can get everything you need in one simple place: trade alerts, updates, reports, bonus materials, everything. So you can easily download your monthly stock selection report. You can see right there, they're very easy right at the top. You just click on one of the links, whichever month you're downloading, and off you go. You can also grab your Saturday reviews every Saturday morning at 10 a.m. Again, this is when we'll update you each week on the overall performance of our trades, help you make sure you know which stocks you should be holding, whether or not there are any actions that need to be taken. We also take a quick look at each company in the short-term investing portfolio, so you know what's affecting the stock's price and what we expect to see in the near term. So it's our analysis. You'll never miss a strategy session because you can always access the recordings in the archive here to keep up with the members-only special sessions. And when a decision trigger is reached, you'll also have immediate access to the trade alerts on the members' website, plus by email and by text message, so you'll always know what to do. And our unique little calendar gives you a quick glance at what's on the schedule for the week, the month ahead, so you'll always be able to register for the next strategy session. You'll know when special events are taking place, and much, much more. Also on the members' website is easy one-click access to all of the bonus reports and training materials from the Millionaire Blueprint plan, the free bonus reports, the PE gap training module, the capital management spreadsheets. Everything's a click away for you from here. Now, that's a ton of value that most of the programs don't ever give you. Stock recommendations, ongoing access to your Millionaire Blueprint experts, access to the 700 plus members in the community, the bonus reports, the capital management spreadsheets, instant access email support, training videos, all of that in a no-hassle 60-day trial for $79. No other program provides a complete step-by-step investing plan where all of the work is done for you. Again, you get the $1 Million Portfolio Report, the members-only website, the bootcamp videos, 2 months of stock selection reports with up to 10 stocks each month. That's 20 total stocks over the course of your trial. The ongoing trade alerts, the email updates, the Saturday reviews, the 2 bonus reports, the capital management spreadsheets, instant answer hotline, all of that, $79 for the next 60 days. But again, the deadline is going to be Tuesday at 7 p.m. Eastern time. So once you've completed your 60-day trial reservation, you'll be taken to our welcome and thank you page. Please take 2 minutes to watch this short video. It tells you how to make certain you get the 2 confirmation emails that you need. And we've had, there are issues out there with emails, so I want to make sure that everybody gets what they're supposed to get. One of them has your login and password information, so as soon as you have that email, you can instantly log in right on this same page. So you watch the video, and then you can log right into the Millionaire Blueprint Member Center. So then once you're in the Member Center, I want you to watch that Millionaire Blueprint Bootcamp training video. I'll show you how to find it here in just a second, but I also want you to do this first once you get into the members website, and that's register for the strategy session that we're holding this coming Sunday night, that's the March 29th at 7 or 7:30 p.m. So I think it's 7 p.m. Sorry. So again, it's a live strategy session. So I'll be able to help you get ready for your very first trades next Wednesday. So you want to register for that. It's right up at the top, the big green button. It says register for the webinar. Make sure you do that first. Then after you register for the webinar, then I want you to watch the bootcamp video. So it is a long video. It's up to 2 hours. That includes about a 45-minute Q&A session in there. So it's really, really long because of the Q&A. But watch it in little 15 or 30-minute segments. You'll be very well prepared for Sunday night, plus next Tuesday when you get your first stock selection report. In fact, again, your first stock selection report comes out on Tuesday night at 7 p.m. So you'll be able to log right into the members website here, and it'll say April 2015 right in that little box there. The box isn't there, but that's where it'll be. And you'll be able to download, get the 10 stock selections for the new month, plus our specific instructions for building your new short-term portfolio. And you'll discover we do all the PE gap calculations and analysis for you too. So you'll know exactly why each and every company was recommended. So then we also take a quick dive into the analysis of each company and provide you the exact buying instructions. So now remember that we use market orders, not limit orders. We're buying our 10 stock short-term portfolio on the first trading day of each month. We're not market timers. We're not trying to get cute with our orders. We want our money working as quickly as possible. Now, some may ask, why don't you use limit orders? And I'll give you the simple reason. It's to ensure that all members can get their orders executed. Market orders guarantee that. Limit orders do not. So this way, you know that you'll be able to capitalize on every one of our stock selections. You're not going to miss out because you couldn't get in on a good thing. So, and the same is true when we exit a stock. We'll keep it just as simple for you to make sure that we can get you out at those 20% or better gains. Now, I'll cover much of this again on Sunday night in a special strategy session with you. But here are the steps again. Once you have your stock selection report next Tuesday, a week from tomorrow, you're going to first enter the trades on the first trading day of the month. That's going to be Wednesday, April 1st. Now, you'll get your selection report at 7 p.m. Tuesday, March 31st. So you can enter these trades in the overnight hours just by estimating the number of shares to buy. Guess what? The capital management spreadsheets do that work for you. Then follow the rules of investing once your trades have executed. Follow our Tuesday, Thursday updates and our Saturday review. We'll also keep you up to date with trade alerts and exit alerts sent by email or text. And then when those 20% triggers get reached, we want to take our gains, close those trades, and then repeat the process the next month. That's it. It's that simple. Again, and based on our returns averaging just over 5% per month since October of 2013, when we started this program up, you can enjoy a stress-free investing plan that gives you back time. Time with your family, time to do things you want to do instead of worrying about which way the market's moving today or tomorrow. You'll discover that we're doing all the worrying for you. You'll never be alone. We're with you every step of the way. We give you all of the tools you need to be successful and to build a secure portfolio that's never at risk of losing it all. So don't wait thinking that you're going to do this later, because later never comes. Let's all just be truthful about that. Do not wait thinking that you've got time on your side, because as we've shown you, most investors simply do not have 30 to 40 years to wait or hope to be financially secure. Reserve that 60-day trial immediately and let us show you what successful investing can really look like. We're looking forward to seeing you on Sunday night in that strategy session. Again, once you get in, make sure that you get into the members website, watch the little video, log in, and reserve that seat for the Sunday strategy session that's members only. So if you don't get in, you're not going to get an invitation to the Sunday strategy session. Only my members will be part of that special session. Now, again, it's a 60-day trial for $79. After the trial is over, after the 60 days concludes, you can choose to continue on for $79 a month, or you can upgrade to an annual membership and save 33%. But that's only after you've made absolutely certain that the Millionaire Blueprint program is right for you. We realize, we know this investing plan is unique. It's different because most investors, frankly, don't have a set of rules. This works because we don't just get you in, we also get you out. Most programs are great at getting you in, but then what? Then you're on your own, right? They don't help you get out. And that's why we know, in part, this isn't for everyone. Some people just can't trade. We get that. We totally understand. But only you can decide if you want to take control of your financial future or whether you want to hope to survive on government handouts and lottery tickets. Now, as I said earlier, this is not a get-rich-quick scheme. It's a building wealth slow, steady, and smart. You're always protecting your money and your portfolio first and taking your gains when they happen second. And that right there is why this investing plan can work for you. It's what makes this plan different. Now, you can go it alone, but the buy and hold, index fund, traditional investing, guaranteed to take you 60 years to get there. We're offering instead a safe, smart shortcut to slash your waiting time to about 8 years. If you're in, Reserve that 60-day trial right now. Yes, there's a deadline. Yes, there are limited seats available, but start learning immediately so that you're ready to place that first profitable trade next Wednesday on April 1st. Now, I'll do some Q&A here. I know I ran over on my time tonight. I apologize for that. So I will try to stick around and answer as many questions as we have in here. So just hang on just a second while we back up. And Jerry asks, do you use options at all? In this program, Jerry, we don't use options. It's a good question. I'll briefly explain why we don't use options and then how you can use options. We don't use options for number one, because not every one of our stocks that we recommend is optionable. It doesn't mean that the company is bad. It just means that you may not have sort of fair pricing on the option. It may not have options. They may be low liquidity. So there are too many issues with some of the companies that we recommend as it relates to the options market that we've never gone in that direction. That being said, if you're a smart options trader and you want to construct an options trade around one of the recommendations, you can do so. But the biggest issue that you're going to have is just because we recommend a company doesn't mean we know when that 20% trigger is going to get hit. On the profit side. On the loss side, you can certainly use put options to protect yourself. But again, you've got to balance out what's the cost of that option versus the gain versus how much am I losing on the trade. Things of that nature. So it's much more complex than it sounds like it would be with options. But the core here is growth of portfolio. This is not speculation for the sake of speculation. That's one of the challenges with options trades is you're speculating in the hopes of hitting the home run. These are singles and doubles. That's why we're recommending stocks, and that's frankly why we don't use options. But a fair question and a good question, and we're not. We use options in other programs, and with our options expert in one of our other education programs here. So I'm not downplaying or saying that options are bad. I'm just saying they're not best for this program. We stick to what we do best here, and that's stocks. So great question. David, I know that you calculate the one number with a future stock price. $51. The one number, David, when American Airlines was traded back at $34.50 was about a negative 49. The irony in that is that you actually have to look at the earnings estimates, not just the stock price. If obviously you can't get historical earnings estimates because they aren't tracked that way. You could sample them, so to speak, by looking at what the earnings estimates were 90 days prior, and then find a stock price and do a calculation that way. A lot of work for very little information, to be perfectly honest with you. But it was at about a negative 49. So the irony is that as oil went down, earnings estimates for airlines went up spectacularly. If you go look this up on Yahoo, you can look up UAL, DAL, AAL, ALK, that's Alaska Airlines, LUV, Southwest Airlines, and you can see the rapid rise in earnings estimates just over the last 90 days. And for American Airlines, their earnings estimates have more than doubled for 2015. That's this year. So you remember the example that I had there showed you their earnings estimates for 2015 were $5. They're now $10. So the earnings estimates for American Airlines have more than doubled for the current year since we took that snapshot back in December. So there you go. Victory. I'm sorry, it was $8. So it's 20%. It was $8.72. My fault. I'm looking at the wrong number. It was $8 for 2015, and now it's $10 for 2015. So they a 20%, 25% increase in the expectations on earnings alone, even though the stock price was $17 higher. The earnings estimates had risen that dramatically, and that was all related to the price of oil. I mean, it's the simplest of trades right now. Oil down, airlines up, oil up, airlines down. You've got an easy 2 to 5% range on every stock in the sector when oil prices move. So there you go, free trade for everybody. That's called socialism, folks. Do you have to invest all 10K at any given time? Yes, you do. You need to be completely invested when you're following this process. Otherwise, you're not going to be able to capture. You can't cherry pick. If you try to cherry pick the trades, if you try to outsmart the process, what happens is you wind up picking all the losers and missing all the winners. I get it. Everybody wants to try to outsmart the systems. Guess what? Systems, approaches, methodologies work for a specific reason. If you break them, they don't work. So yes, you have to be invested in as many of the positions as you possibly can. Now, that if you don't have enough capital to buy all 10, that's different. And that's why what we do is we rank the stocks for our members. So if you only have $3,000, you may only buy 3 positions. That's okay. You're still buying the top 3. What you don't want to do is just, if you have $10,000, is not buy a position because maybe you don't like the stock. You can try to do that, but again, be careful about cherry picking. Do you consider volume, capitalization, and market direction? We do consider volume. We do consider market capitalization. From a volume perspective, we typically want stocks that are trading 250 million or more. So basically small caps and higher. Volume really has to trade at least 100,000 shares any given day. Otherwise, it's too thin volume anywhere below there. Market direction, no. Market direction is not relevant to what we're doing. The reason market direction isn't relevant is because we're looking at companies that have a fundamental basis for their valuation growth, if you will. So we're looking for companies that have future growth at a price that's discounted today. But great question there. And too bad you didn't put your name in, so I can't call you out and say, great question, there's an insert name. So how do you keep track of returns, short, medium, and long-term portfolios? It's all done for you in the capital management spreadsheets. David asks, how will this program perform in a down market? The same way it will perform in an up market. Because honestly, David, there's no difference. Everyone's worried about bear markets. Stop worrying about bear markets. You're not in one. Go look at an S&P 500 chart from 2010 to 2016. What does the chart tell you? It tells you that you are in a bull market. That's it. That's all you need to know. You are in a bull market for the foreseeable future. Bear markets last 1/5 of the time of bull markets. So stop worrying about bear markets. This will work just as well in a bear market, and I'll tell you why. We won't trade as many stocks because if you're in a bear market, you'll have more companies whose prices are declining than rising. You'll have the opportunity to use ETFs in place of stocks, whether they be index or commodity or currency ETFs, or even bond ETFs, which have the potential for growth it's not going to be the same percentage. You're not going to get 20%, necessarily going to get 20% growth, but you still have the chance to get 5, 8, maybe 12% in a short period of time. But I mean, go back and look at 2008, 2009. How long did that last? 6 months. September, October, November, December, January, February. By March 9th, you hit the low and the markets rebounded. That's it. A bear market lasts 6 months. So, in the context of 8 years, you're going to hit 1, maybe 2 bear markets, maybe 3. And really, you're talking, bear markets are one thing, corrections are another, and corrections are happening ongoing. Right now, the S&P has a range that's in excess of 5%. That's a pretty wide range. That's based on the volatility of the last 3 months. So with that kind of volatility, if the market goes down, if the S&P goes down 100 points from where it is today, is that a correction or is that still a range-bound trade? That's the challenge that you have, and that's why it's important to look for stocks that are undervalued today, especially with the market at record highs. Now, in a bear market, there are still certain stocks that will go up. There are stocks that will defy that logic of the market going down and rise. So you still have opportunities to profit even in a bear market. You don't have to run and hide. But a great question and a fair question, David. Thank you for asking. Do you have a group of stocks that you choose from? Eddie, the stocks will change typically every single month. And that's because of the ranking of the stocks taking place at the end of every single month. Jerry, do you try to avoid earnings? No, not necessarily. From time to time, we may. Remember that in part of the context here, part of the construct here is You may be in a situation where earnings are the conduit for momentum in one of the trades. It's not the reason for making the trade. In other words, we're not banking or betting on earnings, but earnings can be sometimes that the fuel that starts to propel the stock up that escalator. So, but the converse can also be true. If we feel we have if we're sitting in a stock that we feel may be overexposed to a negative earnings report, we may tell people to cut it and save themselves the pain. Stephen, great. Fair enough, Stephen. Jamie wasn't running the program back in 2011, so it wouldn't be a fair comparison. Overall, of the stock selections that we make, now up to 10 per month, 62% of them hit that 20% target. Now, that variance, it's about 81 days on average, 82 days on average. So you can see why we're holding from 0 to 90 days. And that 20% target is happening within that 0 to 90 days. So a much better win-loss ratio than other programs out there. So again, the trial, the cost after the trial is $79 per month, should you choose on, or you choose to carry on, or you can upgrade to an annual subscription and you get a 34% discount. But generally, no, we don't look at ETFs on a regular basis. We may use an ETF from time to time, but we don't generally use them. So, Jerry, are the strategy sessions in the evening? Yes, the private strategy sessions always are. Assume a portfolio of 10,000, 20 trades, 3-month cycle, trade cost 10, trading cost is 2%, and your 5%. Trading cost 20 trades per 2-month cycle. Again, you're worrying. I don't know your name, so I apologize for sort of being the hard ass here, but I'm going to be honest with you. You're worrying about 2 percentage points on your trading costs versus the opportunity to grow your portfolio. You're focused on the wrong thing. Honestly, I'm sorry. That's a blunt answer. Trying to figure out how much, it's one thing to figure out if you're going to make 10 trades per month over the course of a full year. Let me explain why what you're focused on is the wrong thing. If you make 10 trades a month over 12 months, that's 120 total trades. Your commission front and back is a known cost, just like running a business. It's your CODB, cost of doing business. You factor that out in advance, okay? So for every trade that you're going to make, one of the things that I teach you in one of the free bonus reports that I give you called the Advanced Profit Strategies is what I call the risk reduction strategy. What it teaches you is how to recapture your commission cost from the broker in every trade. They're totally free. So now you don't have to worry about your percentages being reduced, which is why I created that strategy for you. And it's why I also call it the risk reduction strategy, because what it teaches you is how to eliminate from the 10% loss trigger effectively to 0, so that the worst case scenario for you is a break-even trade inclusive of trading costs. So again, if you guys want to sit here and do calculator math all night about how much your commissions cost you, honestly, you're spending your time worrying about something that you can actually figure out how to get back. So let's worry about getting a 20% winner in the bank first, and then we can figure out how to make sure you get your costs back. Because I also teach you in that report how to get the cost of your subscription back, doing the same thing, following the exact same principle as recapturing the cost of your trading commissions. But your commissions are a known event. You're going to pay them one way or another. You cannot trade for free unless you do this one thing. So fair question. Sorry about the harsh answer. I'm not trying to be rude. It's kind of like focus on how else are you going to get there? How else are you going to reach your financial goals? That, I think, is a much fairer question. How am I going to get there with you with this program? And you're going to get there by having stocks that are selected that have a fundamental rationale for being selected. This is not technical trading. This is not day trading. This is not auto trading. This is not mechanical trading. These are stocks fundamentally selected by an expert with over 25 years in the market that are then combined with a plan that compounds your money month after month after month. So you know what? Maybe you'll make 30% this year doing this. Did you make 30% last year? Most people didn't. Most people made about 1.5. So anyway, there you have it. So Q-Man, should we sign up with a certain trading platform like E-Trade so we can be ready for April 1? E-Trade is just fine. I use them. You can also look at IB, that's Interactive Brokers. Thinkorswim is an excellent platform. Many people would recommend Thinkorswim. Any of the online broker platforms absolutely can help you. So, Joseph, what is the cost after the 60-day trial period? Again, that's $79. What happens if you have multiple down month in the markets? We kind of covered that. What if I want to invest more than 10K? Then you divide your total investment amount into 10 equally weighted capital segments. Make sure, again, you divide by 10. So if you start with $18,000, then each individual bucket would be $1,800 instead of $1,000 in my original example. That's it, Armand. That's what that would be the difference. Thanks, Stephen. Again, Jamie started his program with the Millionaire Blueprint in 2013, in October of 2013. Just to clarify that for you. Thanks. Will your Excel spreadsheets work with Google Docs? Yes, they should. Since this one number is based on future valuation, how do we know that we will see a rise inside 90 days, not 190 days? Because the market is typically pricing ahead 6 to 9 months. So in other words, the prices that you see today are what the market thinks the company is worth 6 to 9 months in the future. Remember, the Wall Street operates on a forward-thinking speculation, if you will. Forward speculation, I guess, is a simpler way to say it. In other words, the way that they're pricing the market today, it's not the value that they actually see in the market today. It's the value that they see in the market 6 to 9 months from now. So if when the market goes down, it's because at some point the traders on Wall Street think the economy is going to go down. They're not usually reactive. They generally are the trend. They're not following the trend. But when the market is pricing individual companies, and this is one reason why you see companies move up and reprice so rapidly. I mean, it's the equivalent of lemmings and the cliff. You've all seen that, right? The lemmings, the fall off the cliff, right? One lemming hops onto a stock, and then 10, and then 100, and then 1,000, and that's how those stocks start to rapidly rise. That was a great question, though. This webinar is recorded, yes. Stephen, the stock selection is different because, number one, Jamie uses essentially his own qualitative analysis. It is an automated system process that he has built. It's a similar process that he used when he ran a #1 newsletter called The Rational Investor. That's back in 2003, 2004. It's a system that he has been using to pick stocks for the last 10 plus years. He brought it to the Millionaire Blueprint program. We tested it with our rules in 2013 in the early part of the year, and then we went live. And the results that I shared with you from October to 2013 through February of 2015 are the results he has turned in running the Millionaire Blueprint program. Nico, what is the smallest size account for which your program is viable? Honestly, Nico, $2,500. It's really hard to get going with anything less than that because you can't buy a couple of stocks. You've got to be able to buy 2 or 3. It's a good question. Really, you need to be, $2,500, $300, $3,000. We're about to release a new product, really just a monthly newsletter for folks who only have like $500 or $1,000. So we'll be helping them in the near term. But if this is what you're looking for, $2,500 to $5,000 is probably the like minimums to get started. Divide by 6 months equals 20-ish%. Great explanation. Yes, exactly. There you go. Q-Man's got the numbers down. Excellent. All right. So I'll just leave a couple of extra seconds there for any last second questions. Remind everybody again, Tuesday, March 31st, 2015 will be our deadline. Do get in beforehand. If we have, can the system be done in an IRA account? Yes, it can. If you can buy and sell a stock in your account, then you can follow this model because you're not doing anything that's unusual. You're not doing anything that requires any special dispensation from the brokers, so to speak. So if you can buy and sell a stock, you can do it in any kind of account: Roth IRA, some 401ks if you have stock buying ability. Most don't, but some do, and regular investment or brokerage accounts. So I would always recommend using a tax advantaged account where possible. Always check with tax preparer or tax advisor if you have one. Qualified financial advice in that regard. Obviously, you want to try to avoid as much as possible doing this in a taxable account if possible. But if not, your taxes will not significantly impede your ability to get to your goal in about the same time frame. So, all right, thank you, everybody. I'm going to stop the broadcast here in about the next 10 seconds. There will be a recording out to you guys in just a little bit, and look forward to seeing everyone on the Sunday night strategy session. Remember, first thing, once you get in, make sure you register for that, and then I will see you guys on Sunday night with the rest of our membership family. So thanks, everyone. And yes, I do send recorded links, so that'll come out to you by email probably within about an hour after we finish. So even if you go to bed, it'll be there for you in the morning. I want to thank everyone for your time tonight and for all of your great questions and for letting me stand on my little soapbox from time to time. So, Stephen, I hope you come back and join us. And if not, totally understand. But for everybody else, for all of us here at Traders Reserve and the Millionaire Blueprint, I want to thank you for your time, and I hope you have a pleasant evening.